Hi, my name is Darren, and this is HCJ.tax, and we're a team that seeks to demystify that sometimes confusing world of international tax. And today we again have the honor and privilege of having a conversation with the one and the only Mark Morris. Mark, can you please introduce yourself?
Yes, I'm an expert in automatic exchange of information and exchange on demand, and I've been consulting for the OECD and the EU Commission and the EU Parliament since the days of the EU Savings Tax Directive in 2002. And I've done nothing else for 25 years but focus on exchange of information. And I give seminars and websites, etc.
Okay. Could you talk about strategies to transact crypto outside the scope of CARF? Is that possible?
Yes, there's a few. There's about five or
Yeah.
six. So
Okay.
the easiest one, I think people say that CARF will squeeze the gray out of the market. What this means is people will use a reporting crypto asset service provider in a non-participating. So only 69 jurisdictions as of today have committed to implement CARF, but there are more and more. There's 9 more. Funny enough, countries like Philippines that didn't implement CRS are implementing CARF. I think because they see people ran away with crypto or hiding with crypto. The problem is many countries, EU and Switzerland, extend CARF extraterritorial to these reporting crypto asset service providers wherever located if they service the domestic tax residents. So if you're in some country that hasn't adopted CARF, but you service clients in the EU or Switzerland or wherever, then you're in scope extraterritorially and they could fine you and stop you doing business, etc. And now, also, the problem with this strategy is new countries will join CARF under pressure from the OECD. I think to start with 69 is a lot because
Yeah.
only about 40, 45 started with CRS, and then now it's 115. Okay. So the second strategy to avoid or to be outside the scope of CARF is you move your tax residents to a non-participating CARF jurisdiction or a zero tax. Funny enough, there's a lot more countries with no tax on crypto, like Belgium or Germany after a year, rather than go for Monaco or Dubai, etc. So it's far easier to go move to one of these. I think Portugal is another one that after a year, holding it for a year, there's no tax, etc. However, CRS and so will CARF requires enhanced due diligence when residence is recently moved to a list of high residence by investment jurisdictions, Malta, Cyprus, UAE, Monaco, Caribbean tax. But I think they're behind. I used to consult for the OECD on this residence by investment, but now they're behind because now you've got countries that don't tax crypto. Okay, even Switzerland, if I keep my crypto for a year and make a profit, there's no tax. Okay. Now, the third one, and this to me is the best solution to avoid crypto. You use a nominee entity, which is not a financial institution, which is a reporting crypto asset service provider in a non-participating jurisdiction. So you use a nominee, which is this a company, but it's held by a reporting crypto asset service provider in a non-participating jurisdiction. So I use custodian institutions. So a custodian institution in a non-reporting jurisdiction holding an investment entity or an entity. So it doesn't any entity. So because that underlying company holding the assets at the crypto exchange, they're a nominee. They are holding the assets on behalf of the custodian institution. Therefore, just like CRS, the crypto asset service provider must look through that nominee, because a nominee in automatic exchange of information is not the account holder. It's the party that you're holding it for. So if you're holding it for a custodian institution in a non-participating jurisdiction, then there's no reporting. Okay. So the other two solutions is DeFi protocols directly from if you use it directly from yourself custodial wallet, distributed, I forget what DFJ stands for, distributed financial entities. So the protocols, but the OECD is trying to include this because they know it's a loophole. And then finally, you can use these privacy coins, such as Monaco or Zcash protocols, because they obscure the transaction details. But the OECD has come down hard on these, and I've seen the reports, and major crypto asset service providers are not accepting transactions in these privacy coins. Okay.
Wow. So I guess, the takeaway is the big opportunities would be non-participating jurisdictions, or as you say, no tax jurisdictions, that just don't tax it. Yeah. Okay.
Yeah. It's easier to have a non-participating custodial institution than to be tax resident in a new country. But the list of new countries is much wider than trying to escape CRS.
Exactly, because some of those jurisdictions that don't tax long-term gains on crypto, they have a whole other range of taxes to deal with. So that'll be the least of your problems, right? So the best bet, as you said, will be a non-participating jurisdiction rather than Europe that may be no tax. Yeah,
jumping from the frying pan
into the fire.
If you move to Germany, Belgium, I think Belgium tax rate is 50% on income.
Okay. So, Mark, if anyone wants to reach you and contact you to find out more about these tax planning and structures, what's the best way to do so?
Well, it's easy to just Google Mark Morris CRS or Mark Morris Automatic Exchange. But my website is www.co-ownershiptrust.com. The co-owner is got a dash, a hyphen.
Okay, thank you very much for that.
But it's easy to find me just Googling me, Mark Morris OECD, Mark Morris. I've got articles on The Economist. It's easy to find me.
Fantastic. Thank you.